I was wrong. I was wrong. Sometimes that's the hardest thing for someone to admit, but in the investing world, it's extremely important to be able to admit when you're wrong. And we all have these personal biases, like you hear a company's name, Google, Tesla, Microsoft, Costco. You already have these like preconceived biases, whether you like the company or not. And our goal is to maximize investment returns, be the best investor possible, make as much money as possible, and we don't want these personal biases getting in our way. Now, we'll probably never be able to completely eliminate it, but I mean, 5, 10 years ago, I wasn't invested in any tech companies because I was listening to these people online who were like always saying that stocks were overvalued and a crash was inevitable, and just all this doomsday talk. And there's a lot of reasons to be a doomsdayer, but like there's a lot of problems in the world. There will always be problems in the world, but that doesn't mean certain companies aren't going to make fortunes. Like there's a lot of crises that won't affect the bottom line of certain businesses and sometimes even help them. So anyway, today we're going to talk about NVDA. Now, for years we've been hearing about this company, AI bubble, the AI wave, and I had it. My philosophy was I don't want to invest in a company that's like on everyone's mind. Like I wanted to avoid, like a Peter Lynch line was, avoid the most popular stock in the most popular industry. And that, for years, it's kind of been Nvidia, and I was cautious of the company from the standpoint of like, oh, everyone's already heard about it, and it's too late. That's like the main, like, no one's going to say Nvidia is a bad company. No one's going to say they don't make much money. As an investor, the pretty much primary concern is it too late? Now, I've come to the conclusion that it is probably not too late. Now, I'm going to go into like why that is now. So first, the forward PE matters more than the PE. This is the price to earnings ratio. This is the price the company's selling at this, relative to the money it's actually making. Now, this is the last 12 months. This is a snapshot of today, whereas these two are the last 12 months. This PE ratio is using these two numbers, or no, this first line and the third line. Price to earnings ratio. Now, 33 historically is a little high, but 22 for a dominant company is not bad. In fact, I bought Alphabet a bit over a year ago at a PE of 20, and now it's at a PE of 30. That was one of my best moves. So the concern here is, so this means this is based on the expected earnings by like a median, like a mean of the consensus projected earnings of an analyst. Now, those earnings might not happen, but it's a pretty reasonable estimate. Plus, it's the average of a bunch of estimates, so you can kind of assume it'll be around there. Now, it of course won't be exactly. Let's see here. So we go to financials here. Now, I've looked at a lot of financial statements now from a lot of different industries, from a lot of different companies at various parts of their life cycle. To have revenues growing 95%, over 85% year over year, when you're making this much money, is just absolutely crazy. Now, of course, the first thought of your mind should be, is this growth sustainable? Now, I don't think this exact rate of growth will be sustained, but even if they grow their revenues at like 60%, 50, 40, that'll still be damn good for a company this size. The thing is like, you would have to look at thousands of companies' financials to find a company growing like this. It's just crazy, and This operating income, I believe, is the record operating income of like ever. Like Google had higher net income this last quarter, but I think that was just from one-time anthropic uh, unrealized gains. Yeah, like Alphabet's recent quarter had $63 billion, but the operating income was only 40. Operating income $53 billion. So this last quarter, NVDA made more operating income in a quarter than any company in human history. And the net earnings, like, they made triple the money in Q1 2027 versus Q1 2026. It went from 19 billion to 58 billion in a quarter just in a year. The EPS is just skyrocketing. I mean, it's just yeah, like the trajectory will probably slow down. But when you look at a company with financials like this, it's unignorable. Like, the financials are just so good. They're so good that it's worth the risk. Like, just ridiculous. They're doing buybacks. I mean, they did record amount of buybacks of their own stock. They just raised their dividend to be like kind of like the same yield that like Google and Meta has. Like they just have this like small dividend. They raised it. It doesn't show it here, but they raised it from 1 cent to 25 cents. You can see it here. Like the forward dividend is $1. Divide by 4, 25 cents a quarter. Your average analyst, I mean, we went to having zero. There was one strong sell this whole time. Now there's finally no sell. Look at these 5-star rated analysts thinks there's a 92% upside in the next year. Basically, every government and every company going into AI is dependent on them. So, yeah, it's like, man, like, is it too late? Like people who bought in a few years ago, they scored a grand slam, no doubt. But the idea is that like it probably, I finally bought NVIDIA this last week. Like I was stubborn. I didn't want to give the world the satisfaction of admitting I was wrong and they were right. But like 10 years, 5, 10 years from now, if this company keeps going up, like it will have been the right decision to suck up my pride, cut my losses, and now finally enter the company. And so I just wanted to kind of like bring it to your attention that like, I have a feeling that there might be a lot of other investors out there who are just like, I'm going to avoid NVIDIA. It already made its run. Like, this comes back to like, I believe that 99% of capital is driven by people who don't know how to read financials or don't take the time to read the financials. And an advantage that you have here as an investor is like, even with all the idiots who own NVIDIA and are aware of NVIDIA, well, they don't look like idiots now, just like they're not an idiot to have owned NVIDIA, but like there's a lot of NVIDIA shareholders, I bet, who don't know how to read financial statements, and they like rode that wave, and they made money for reasons other than being a good financial analyst. They probably saw like the macro wave or whatever, but just if your earnings are tripling, your PE ratio matters a lot less, because like you could have a PE of 60, but if your earnings are tripling, that PE goes down to 20, assuming the stock price just stays the same. That's kind of the situation Reddit's in, where Reddit's PE looks really high, but they just broke profitability, and so their earnings are like tripling year over year, and so that'll like, the PE is just going to drop substantially. Here's another thing. This profit margin of 71.5% is better than like insurance companies. Yet they're manufacturing hardware. Like, just an insane profit margin. So yeah, I just wanted to make a video about admitting you're wrong and what my latest investment was in NVIDIA.